fully approved and issue the funding for you as well. So my team and I are here to guide you through every step of the way in the home buying process. And so anytime you have any questions about anything at all, you're going to reach out to me and I'm going to help you do that. Who is Summit Funding? I think that's more important to explain in the context of the bigger picture. And my goal tonight is to explain all of the things that I think you need to know in order to succeed in home ownership and the home buying process. So there's really 3 different types of mortgage banks you can work with. The first is a big bank. And a big bank, y'all know who the big banks are. I used to work for a big bank. They serve their purpose. The benefit is the big bank has a lot of stability, has been around forever, and you're not worried about them going anywhere. But the truth is the bank's not loaning you their own money. We're getting the money from the federal government. We're getting it via entities like Fannie Mae, Freddie Mac, FHA, and VA. And I'll explain to you in detail about who all of those people are and how they play into the process. But the reality is that a big bank is not loaning you their money. So you don't really have to worry about, hey, am I really going to get the best deal from one institution versus another, because we're all getting our money from the exact same place. That also means that the challenge working with a big bank is they have so many different business lines that they're in, that sometimes they love mortgage, sometimes they hate mortgage. And when you're in a cycle where mortgages aren't their preference, they're going to take resources away from that and put it into a different business line. So there's your challenge with the big banks, is they add a lot of extra rules and a lot of extra requirements, because they kind of say, hey, we're not really in love with mortgage right now, so we only want the cream of the crop clients. So that's a big bank. Then you've got the opposite end, which is a mortgage broker. So a mortgage broker is an independent person that doesn't work for any lending institution. Their job is to find a lending institution that is going to best serve your needs, and then they send the package out to that institution in order to get you fully approved and funded. The flaw there is they don't have control over the process. Sometimes they're sending your loan to a big bank, sometimes they're sending your loan to a smaller institution. So sometimes you have those, what I called earlier, overlays or extra rules that a big bank may add. A broker is likely going to have to deal with those things too, because they're sending their loan to the big bank, but they don't have the connection to the process, because they're not doing the loan internally within their company. So they're dealing with a third party, and that third party can create a lot of wrinkles because there's not a lot of good communication when you've got to go through a separate company. Then the third type of company you can work with, and yes, I'm going to talk about our company and where we fit in, is a direct mortgage banker. So Summit Funding only does mortgages, but we lend money directly from Fannie Mae, Freddie Mac, FHA, and VA. So you kind of get the best of both worlds. You don't have to worry about us saying, hey, we're not interested in mortgage right now, because mortgage is all we do. So if we're not interested in it, we're kind of out of business. The other side of it is that we get the money direct, so you don't have to worry about, hey, am I paying a middleman to provide this money, and then they're having somebody else going to have to get paid too, which is what happens in the broker world, where the broker's got to get paid and the bank's got to get paid. We're the direct lender. That also means I have control over the process, because everybody who touches your loan works for my company. So we have a lot more high touch control to make sure this is a great experience for you. So specifically, Summit Funding is the 25th largest mortgage bank in the country. Sorry, just adjusting my headset. 25th largest mortgage bank in the country. So I think we're perfectly sized. We're actually based right here out of Sacramento. So we're local, but we're national. So we're in about 42 states across the country, and we're perfectly sized to take great care of you. And we specifically focus on 3 keys. The 3 keys that we focus on is the key to the front door, the key to the back door, and the key to the garage. No, I'm totally kidding. The 3 keys that we focus on is, first and foremost, communication. It's kind of why I'm doing a presentation like this, because we pride ourselves in being high touch and communicating, especially when it's your first home, but even if it's your 4th time going through the process, it's hugely important to have somebody that communicates well. And we think that's really, really important, because it's one of the major complaints about the mortgage industry is mortgage bankers, they don't communicate. They don't tell you what your what's going on with your loan or where you're at, and that's a huge focus for us. The second thing is we think we deliver the finest client care in the lending industry. Now, this is a little bit of we're the best of a group of really bad people, let's say it that way. The mortgage industry has been blamed for collapse in the global economy, and the full weight of the federal government has come down upon us. So we are dealing with a lot of regulation as we go through the process. It is a challenging process, but we are focused on giving the best service we possibly can through that challenging process. The third thing that we think is hugely important is timely closings, because you've got to set a date when you're going to be moving into the house. You've got to coordinate your friends and family to help you move. You got to order the pizza and beer in order to pay your friends and family to help you move. And it's important that you can coordinate that with a reasonable amount of expectation. Some banks say, hey, I wasn't a party to that contract. I didn't pick the date that we were going to close escrow, and therefore it's not my responsibility to make sure I close by that date. We are hugely focused from the top of the company to the bottom. Everybody's number one focus is to get your loan closed on time and smooth. Now, I want to switch focus, and I want to talk a little bit about if this is a good time to buy a home. And this is the question I get asked a lot by people who are in the home buying process, thinking about buying a home, and they say, gosh, John, is this a good time to buy a house? Well, let me speak from my experience. So first and foremost, I've been doing lending for the last 19 years. So I've seen multiple cycles. I've seen the huge growth that we had in the early 2000s, and then I saw the market crash in 2007, 8, and then hit the bottom in 2011 and take back up to the top. And in that, it gives me a lot of perspective. And that perspective is what I'm about to share with you. And it really comes down to a very simple exercise, and I call it my time machine exercise. And it's, if you know anything about the housing market, I want you to think about whether if you had a choice of purchasing a home back in 2008, right at the top of the market, and you knew you could get a 30-year fixed rate loan, and you also knew that you were going to keep that mortgage until 2020 and you were going to sell it at that point. So you could predict the future in that regard. Would you have bought a home, or would you have stayed a renter? Because that's the number one concern people ask me today. John, should I buy a house right now? Because what if the housing market falls significantly? Am I picking the wrong time to buy a house if the market's going to fall? The first thing I ask them is, how long do you think you're going to stay in this home? If you expect to have to sell in the next 2 or 3 years, it's a gamble. If you think you're going to be here for longer than that, then it's a pretty good bet, and here's why. Because even if you bought a home in 2008 at the absolute top of the market, the benefit is that you would have had a fixed monthly payment that never would have gone up. If you were a renter in 2008 to 2020, your rent payments went up significantly. We saw a huge increase in rent payments over that 12-year time frame. By buying a home, you locked in that payment. The second benefit of buying a home is you were getting a great tax write-off. Every year when you paid your interest, you got to write off that interest, you got to write off your property taxes, and if you were a renter, you get absolutely zero write-off during that time. So hold on one second. Somebody's telling me there's an issue with my password. Hold on one second. Where did he go? All right. Somebody just messaged me. Hold on. So it's capital J. All right. And capital K. All right. So anyway, forgive me, I'm just going to double check and make sure I got that correct. Yes, capital J and capital K. All right, so password was J, loan K. All right, so you've got the rent payment that is not going to go up, or that did go up. You've got the tax benefit that you got to write off if you were a homeowner, and if you were a renter, you didn't get the tax benefit. The other thing that you've got is you've got not appreciation, because housing prices dropped and then they went back up and they're now at or above where they were at the peak of the market. So you didn't make money on appreciation, but you made money through forced savings. Every single month you made a payment, part of that payment went into paying down the balance on your mortgage. If you were a renter, you're paying down the balance on somebody else's mortgage. So it's not about timing the market of when you get into the market and when you get out of the market. It's time in the market. The longer you're spending in the housing market, the better off you are. And that's my best advice for people who are thinking about buying a home is don't focus on the short term, because unless you're planning on moving, you really long term are going to reap significant benefits from being a homeowner. All right, so let's dive in and talk about some of the challenges that we're dealing with right now. I mentioned earlier that my industry is blamed for collapsing the global economy back in 2008, and that's creating a significant challenge that we've had to deal with. And I want to kind of digress real quick and talk about what happened in 2008, because a lot of people are worried about, oh my gosh, John, what if housing prices drop again? We're going to, we're going into a recession, and that's what happened in 2008. We were in a recession and housing prices crashed. So do you think housing prices are going to crash going forward? I think housing prices are going to keep going up. And there's a couple of reasons why I think housing prices are going to keep going up. First and foremost is the fact that we've got a huge population of potential homeowners that statistically should have bought in the last 10 years, and they put off the home buying process. And those are people that are currently in their mid-30s. Statistically, people start buying homes in their mid-20s, but the current generation didn't do that. A lot of them moved back home and said, you know what, forget it, I don't want to do it. I'm just going to stay, move back in with mom and dad and stay there. And that generation is now in their mid-30s. They're thinking about having kids. They're thinking about getting married, and they decided not to buy a home. Hold on one more second. All right, so they said, you know what, now is the time to buy a home. So we've got a lot of people that have pent-up demand that are trying to purchase a home, and that pent-up demand is expected to continue for at least the next 4 or 5 years. So that's the first reason why I don't think we're at the point where we're going to see housing prices drop. The second thing is people say, yeah, but historically, we had a recession, and a recession caused housing prices to drop. That wasn't true. That was a correlation, not a cause and effect. As a matter of fact, of the last 5 recessions, 3 out of the last 5 recessions, housing prices went up. Well, wait a second, John, that doesn't make sense, because the biggest recession we had was the recent one, and that one in 2008 caused housing prices to go down. It was the housing market that caused the recession. So clearly housing prices were going to drop because the housing market was the problem. It was not the recession that caused the problem in the housing market. The housing market caused the recession. It's just like the recession we're heading into right now. The housing market did not cause the current recession. COVID-19 caused the current recession. So we're not dealing with the same dynamics. So if you take out the most recent recession back in 2008, that means 3 of the last 4 recessions, housing prices went up. Now, why did that happen? Very simply, it happened because you've got interest rates that stay super, super low during a recession, because the federal government is trying to spur the economy. They're trying to get people spending money. And the best way the government can get people to spend money is to give them money super, super cheap. And so if we can get interest rates super low, the economy is more likely to get going faster. That means that as they drive interest rates down, people want to purchase homes, because with low interest rates, you have the cheapest monthly payments compared with low prices and high interest rates, unless you're paying cash for a home. If you're paying cash for a home, you want to buy when prices are really low, and who cares what interest rates are. But if you're borrowing money, you don't care as much where prices are, you care about where interest rates are, because that's the biggest factor in your monthly payment. So this is a super good time to be buying a home during a recession. The problem is everybody else is thinking the same thing. And I kid you not, literally everybody else is thinking the same thing right now. I have had more people reach out to get pre-approved to purchase a home in the last 3 weeks than I've had in the last 4 months. It has been super crazy, and we're seeing a really, really hot market right now. The market literally took off on May 1st, and it has not looked back. So we're seeing housing prices go up. We're seeing multiple offers on homes. So a month ago, I did one of these presentations, and I told people, look, I don't really know what's going to happen with housing prices this year. The truth is, I have no idea what's going to happen to housing prices ever. I have no idea what's going to happen to interest rates ever, but I got a pretty good feel. And what I'll tell you is, a month ago, I said, guys, I think housing prices are going to keep going up. at least starting next year through 2025, 2026, the wild card is what's going to happen the current year. Well, it's no longer a wild card for me. 30 days later, I am confident we're going to see prices go up this year because there is a lot of demand. People have been sheltering in place for the last 60 days and they don't like the place they've been in. So they're trying to get out of that place into a bigger home, into a better home, away from the big city. I'm seeing so many things that are changing. People wanting to work from home and realizing I don't have a space other than my kitchen table to work from home. I need a house that has an office. And people who've been sheltering in place in an apartment have definitely gotten cabin fever or shelter fever, and they've decided they want to make a move as well. So the housing market is super, super hot right now. Keep that in mind because it is super important that you have a good real estate agent helping to guide you. That is my number one piece of advice, is find a great agent that is going to get your trust. You have to trust your realtor because they're going to tell you on a home that, hey, this house, in order to get it, you can actually offer $10,000 less because it's overpriced. Then they're going to tell you on another house, hey, to get this house, you're going to have to offer $30,000 more than what it's listed for because there is no formula that says how much above or below the asking price you should offer. And here's why. Because there's no formula for how the seller and the agent representing the seller decide on the listing price. There's really 3 different scenarios that a seller is going to use to decide how much to list their house for. The first one is the my house is better than everybody else's effect. The person that's emotionally attached to their home and they say, yeah, I know the other houses near me sold for $300,000, but my house is so much better because I've got purple and pink tile throughout the entire house and that was hand painted. It's also pretty ugly and nobody wants it. But in their mind, it is absolutely beautiful and they want to have that home get to the right person who's going to know that this is worth so much more than every other house in the neighborhood. They price their house high. That house you can offer a lower price. The problem is you got to be careful because that person's hugely emotional. And so if you said, hey, I want to get a lower price and I want you to pay my closing costs, which I'll talk about closing costs in a few minutes, they're going to run, and they're going to run because they're going to feel like you're taking advantage of them. How dare that person offer me lower than what I'm asking for and want me to pay their closing costs? Now, the truth is, they may end up taking an offer that makes them even less money because somebody else is only asking for a lower price. But it's emotional for that person. And so you got to be careful when you're adding insult to injury. You're saying, I'm going to insult you because I'm going to lower your price. And the injury is I'm going to ask for a seller cost credit. That feels like you're trying to take advantage of them to the person that's highly emotional. That's the first type of seller. The second type of seller is a seller that actually listens to their realtor, looks at the data and says, yeah, this house is worth about this much money. This is what we should sell it for. The third type of seller is a seller that says, I want my house to be the lowest price on the internet so that everybody wants to come look at my home. Because if you get more eyeballs on your home and you get 20 people wanting to buy it, they're going to start auctioning and bidding against each other. It's called a multiple counter offer. Your realtor will explain it to you, but a multiple counter offer is essentially the seller saying, I've received multiple offers and I am giving back a counter offer to multiple people for each of them to give us their highest and best offer. And in that case, they're hoping that people are one person's gonna come in 5,000 above what they had originally offered. One's gonna come in 25 above what they originally offered because they're afraid to lose out again because they've been losing over and over again in writing offers. And that's what that seller's counting on. So you've got to have a good agent on your side that can help you sniff out whether this is a home that you have to write above, at, or below the list price, because no matter what it's listed for, it will sell for what the market will bear. So be extremely careful when you see that amazing home that is so much better than everything else that's ever been listed at that price point, because that home is likely that third scenario where they're going after the auction effect. It's going to sell for way above what it's listed for, and it's going to tempt you in because you're going to say, my gosh, I have never seen a home this good for this low of a price. And that's the challenge. You're not going to be able to buy it at that price either. So we've got a lot of things you need to be aware of. And the most important thing to get good guidance is to have a great lender on your behalf. Well, that's easy. It's me. and to have a great realtor on your behalf. So if you were referred to this webinar by a realtor, then that realtor is the person you should stick with. Make sure that you've got a good relationship with your realtor and that you understand that they're out for your best interest. I'll also tell you to be careful in calling the person whose name is listed on the sign, because that person, once they show you the home, they are automatically entitled to be your agent. It's called procuring cause. And that agent who showed you the home is the procuring cause, or the reason why you are interested in that home. They are entitled to the commission from you buying that house. And now you've got kind of the fox guarding the hen house. Now, a lot of realtors are able to play both sides of that and to appropriately represent the seller and the buyer at the same time. But you've got to be careful, because when you have the same person representing you and the seller, you got to be careful what you tell that person, because the seller, the realtor has an obligation to take care of both parties. And sometimes that means that they have to disclose things you wish they didn't. And you might tell the realtor, not thinking about it, yeah, I'm willing to spend up to $350, but let's go ahead and offer $340. And if you didn't tell them not to tell the seller that, then the seller says to them, gosh, they offered $340, but I want to counter it at $350. You think they'd go for it? Well, that's a tough position you just put the agent in, because they're representing both sides. And all I can tell you is have your agent be the person that shows you the home. If it's Sunday morning at 10 a.m. and you want to go see that home right then, call your realtor. Ask if they're working and if they're available. Realize they have a family too, so don't expect them to just jump in the car every time that you want to look at a house. But respect their family time, respect the time that they've put in to help you searching to find a home, but respect them enough to have them be the person that shows you the home, because otherwise you are automatically working with the other agent. So that's something that's significantly important as you go through the home buying process. So I want to take a couple minutes and talk real quick about the process itself. The first thing I'll tell you is that we focus on making it not just a great product, but a great process, because I want to make you an advocate or a raving fan of my business. If you go on to my surveys, I get surveys from every one of my clients, and they continue to rave about the process. I've got 4.92 out of 5 on my surveys, and it's because we focus on taking great care of our clients. And if you want to see my surveys, you can go to socialsurvey.me/John King. I think that's the right one. Just Google Social Survey John King and you'll find it. And you can see all of my surveys on there. If you want the link to it and you can't find it, just email me, john@johnloneking.com, and I'll get you the link to my surveys. But I think social proof is hugely important for people to understand that, hey, your peers are getting a great level of service, and that should give you confidence you're going to get that same service from me, because my industry is broken. I told you earlier that it's a pretty broken industry, and specifically right here, this statistic tells you that Fannie Mae did a survey. 68% of home buyers were dissatisfied with the home loan experience. So we are definitely a broken industry, but my focus is to make it a great process, even though it is a broken industry. All right, so the next thing I want to talk about, actually here, just that's my wrap of that comment, is I'm focused on taking great care of you and taking great care of you through the process. Because here's what the process is going to feel like. It's going to feel like you're flying in an airplane. And all of you have flown on an airplane before, and you know that you're going to hit turbulence, and that's not a sign of a bad airline, and it's not a sign of a bad pilot. And it's the same thing when you're buying a house and doing a loan. My job is to get you through the turbulence, not to avoid it. It's impossible to avoid the turbulence. The most important thing is I didn't just serve you hot coffee that you spill all over your lap and burn yourself when we hit that turbulence. So I'm going to be the pilot. I'm going to be in the cockpit taking great care of you. I've got my team that's going to be walking through the cabin, helping to serve you beverages and make sure that you're happy. But know that I am there guiding you through this process every step of the way. But you need to expect some turbulence. There's a lot of things that can go wrong through the transaction that can create challenges. Most of those challenges can be worked out. Sometimes they can't. Sometimes it's simply a matter of you found a problem with the home when you did the home inspection, and the seller isn't willing to do the repairs, and you aren't willing to accept the home in its current condition. Well, that's some turbulence that might stop you from purchasing the home. You just need to be prepared for that as you go through the process. So let's talk specifically about how the process works and the timeline of how it works when you're buying a home. So the first step is to get pre-qualified. That's really where you are talking with me and my team. We're going over all of your income documentation, and we're collecting all of the details about your credit history, your employment history, your address history, and we are determining your eligibility. And that's where we spend the most time talking about strategy. So you're going to spend probably a half hour to an hour with me after my team's gathered all of your information, and we talk about strategy. We talk about what are your goals for down payment? How long do you plan on staying in the home? Is this a first home? Is this a upgrade or a downgrade home? All of these things that you're going to talk about through the process is what we're going to cover on the pre-qualification. The next step once you're pre-qualified is to go out searching for a home. This is the part where it's fun because you get to go check out all the amazing homes. Just realize that in the current environment, it is the law that you have to have a pre-approval letter in order to look at an occupied home. So your realtor is going to require that. In other circumstances, when we're not dealing with COVID-19 and the shelter in place, it's a really, really good idea to be approved ahead of time, but it isn't the law. It is the law during the current environment, and so you have to have a pre-approval letter. Once you find the home and get a contract accepted, that's when we lock in your interest rate. Your interest rate is not locked in ahead of time. That's a ballpark of where rates are at the time we got you pre-qualified. But when you are in fact in contract, we have a conversation, we talk again about strategy, we review your down payment, we review your closing costs, we review the interest rate and payment where it is today, and we make a decision to freeze it in. At that moment, once it's frozen in, that rate is locked and it's fixed for 30 years. It will never, ever change for the next 30 years. So that's a super important moment to make sure that we're evaluating what you're trying to accomplish from a payment and a down payment perspective. And don't forget when we talk about down payment that we also have to include closing costs. I'm going to spend some time in the next half hour talking a lot about loan programs and closing costs and down payment requirements. Once you've got your contract and we've locked your rate, the file goes into processing and we get to review and validate all of the documentation you gave me up here when we got you pre-qualified. So I'm going to put you through the ringer. I'm going to ask you for the paperwork I had asked you for the first time. I'm going to ask you for paycheck stubs. I'm going to ask you for W-2s. I'm going to ask you for updated bank statements. We're going to go through everything all over again. That's because we have to have current information when we get it into underwriting. The underwriter is the person that makes the decision that says you are fully approved, and they might ask for a little bit more information. So don't worry if in this fourth stage you're asked for a little more paperwork. That's common, and that's part of the process. Once the underwriter has given their blessing, we move on to the fifth stage, which is signing of the documents. That's super, super fun. You meet with a notary, even during, and again, we're kind of in a more of a released phase now. What is it, May 28th, just for people who are watching this recorded down the road. So we started the second and potentially third phase of the release, so people are spending a lot more time face-to-face than they were in the last couple of months. But even during the height of the shelter in place, we had to have a notary come out and meet you. It can be done electronically, but California does not allow for electronic signatures. I think 45 other states allow for it. California doesn't. And so the only way to sign loan documents is face-to-face with a notary. It can be mask to mask and gloves to gloves, but it's got to be face-to-face. The final step is getting your keys and moving into your home. That's the exciting part where the process ends. Once you've signed your paperwork, we fund your loan, we get the title company records the transfer of ownership, gives the money to the seller, and your agent gives you the keys, and that is the last step of the process. All right, so let's talk about types of loans, and let's talk about the things that we look at when we're trying to get you approved for a mortgage. So the three things that we look at when trying to get you approved for a mortgage, and they're the only three things we really care about. We care about the cash, how much money you're paying for down payments, closing costs, and reserves. Reserves is the extra money left over after you've bought the house. The next thing we care about is your credit. So credit simply is how well you've paid your bills in the past, because that's the best indicator of how well you're going to pay your bills in the future. By the way, if you have questions about credit, I'm doing a credit workshop in 2 weeks. So I think that's June 11th, I'm doing a workshop on credit. So go to rsvpwithjohn.com and you can register for that workshop, and I'll give you an hour's worth of information about credit, how it works, how to improve your credit, what myths people believe are true about your credit that aren't, and I'll be able to help you get you on the right foot if credit is a concern for you. And the third thing we care about is income. Income clearly is how many dollars you have coming in every single month, because if you don't have enough dollars coming in, I don't care how big your down payment was. I don't care how great your credit is. You can't afford to make that payment. You're not going to succeed in home ownership. So let's break down all three of these categories real quick. The first thing I'll tell you about cash. Cash is a four-letter word. It is a bad word when I talk about cash. Now I'm speaking of cash in terms of green pieces of paper with pictures of presidents. Cash is not allowed to be used when purchasing a home. We have to source all of the money that you are using. And as a matter of fact, I got a new one today. I had a client this morning that got into contract a couple of days ago, and she had, we had told her, hey, you know, we need to document the movement of all your money, no problem. They put she got a gift to pay her upfront deposit from her mom. And I said, okay, how did mom give you that money? And she said, oh, she Venmo'd it to me. Well, that's the first time I've ever seen somebody use Venmo to send $3,000 for a deposit on a down payment of a home, but mom Venmo'd it to her, and then she put it in her bank account, and then she sent the money over to the title company. We're going to figure out how to prove the movement of that money, but we have to prove the money came from the source you said it came from. So if you went to the bank and pulled out $3,000 in cash from mom's account and then walked over to your bank and deposited $3,000 in cash into your account, that's not acceptable, because we don't know if it's the same $3,000. I don't care if it was an hour later, but it's still not proven that it's the same $3,000 in cash. Mom might have coincidentally taken $3,000 out, and you coincidentally deposited $3,000 of drug money. Okay, not drug money, but maybe you pulled a cash advance on your credit card. That's the kind of thing that we're worried about, and we have to prove the movement of money. So hugely important. Moving money is fine, but you have to move it in ways we can prove every step of the movement. And don't move money simply to make it easier for us to see it all in one place. I've had some clients who say, hey, I got $50,000 for down payment and I got $10,000 in 5 different accounts. So I went ahead and transferred money from each of those 5 accounts into one so you can see it in one place, and I only have to give you one bank statement. Unfortunately, they doubled the amount of work I had to do for them, and they had to do for me. Because I said, truthfully, what you did is you made it so I have to prove all 5 of the accounts just like I would have, but now I have to prove the actual transfer of each of those funds to show that it's the same money. So moving the money into one spot does not help make the process easier. It actually makes it harder. All right, so that's cash. By the way, guys, if you have questions about anything, post them on the Zoom chat if you're on Zoom. If you're on Facebook, I've got the Facebook chat open. And those of you that are watching on Facebook right now, feel free to post any questions on there and I'll get to those. Facebook's delayed by a few minutes from what I'm seeing. So if you are posting a question on Facebook, it might take me a couple minutes to see it. Credit is a sliding scale. So your credit score has a big impact on what type of loan program you get, has a big impact on what interest rate that you get, and incrementally better credit makes your loan incrementally better. We think in 20-point increments. So if you're at a 681 credit score versus a 699, that's a 20-point group that is exactly the same in our eyes. So it goes 600 to 619, 620 to 639. So every 20 starting at 600, 620, 640 is another bucket. And the credit is not the same as what you see on Credit Karma. I'm going to go into a lot of detail on that in 2 weeks when I do that workshop, but just in general, know that the credit score we use is not the same as what you get on Credit Karma. So from a credit perspective, you want to have the best credit score that you can, because it gives you the option for the lowest down payments, and more specifically, it gives you the options for the best interest rates. Credit is super important, and credit specifically is something that I tell people, if you're thinking about buying a home anytime in the next year, year and a half, we should talk now. And the reason we should talk now is because sometimes we're going to find things on your credit that you can fix if you have time to work on it. But if you don't have time to work on it, you're going to end up a year from now saying, hey, John, I'm ready to buy a home. I'm going to pull your credit. I'm going to see something that you didn't expect. And you're going to wish that we had pulled your credit a year earlier so that we could have had time to fix that. So make sure if you're thinking about buying a home anytime in the next 18 months that we talk soon so that we can work on those challenges if there are any. Hopefully there are none. But it's better to know for sure if you have any challenges than to think you don't and find out that you do. So credit's a sliding scale. Income is not a sliding scale. I don't care how much income you have. I only care that you have enough income. We don't feel better when you have twice the amount of income that you need. That doesn't offset bad credit. As a matter of fact, it makes us wonder, well, if you make so much money, why can't you pay your bills? So income tells me that there is the means to make the payment. Credit tells me whether there's the desire to do it. And if you have enough means, I don't care if you have 3 times as much as you possibly need, bad credit tells me you're not going to choose to put that income towards the mortgage. You're going to choose to put that income towards going to the movies and going out to dinner and betting on the ponies. I don't know what it is, and obviously I'm making light of credit. I know we all have some challenges and skeletons in our closet, but the reality is income is black or white. You either make enough or you don't make enough. Income definitely drives the amount you qualify for in a purchase price, because your income essentially says, hey, based on if I make $5,000 a month, I can let you spend up to half of that in most situations. That's where these numbers come in here on debt to income ratio. So I might let you spend up to half of that. Therefore, I'll let you spend $2,500 a month towards all of your bills. And you might have $500 of credit cards and car payments. So I'll let you spend $2,000 on a mortgage payment. Now, if you make $10,000 a month, then I'll let you spend $5,000 between all of your bills. And if you had $500 a month of credit cards and car payments, then I'll let you spend $4,500 towards your house payments. That has nothing to do with what you're comfortable spending. Your comfort level and how much you're willing to spend each month is a personal decision. I don't know what you spend on eating out. I don't know what you spend on kids' activities. Only you know what you can afford to spend. But what I will tell you is, don't short yourself when it comes to saying, okay, well, I spend this much in rent and I can't afford to spend any more than that. Well, you're going to get some benefits like a tax write-off that means you're going to make more income on your paycheck every single month. You're also going to get savings because part of that monthly payment is money that's going towards your pay down of your mortgage. So maybe in the short term, we decide to decrease some of the money you're putting into savings elsewhere. Maybe that means we lower some of the money you're putting into your 401k for a short period of time in order to afford to buy a home. But that's a very, very important decision that we can make together to look at the pros and the cons. I'm not telling you retirement funds aren't important, but what I am telling you is that your leverage, your growth of your assets is going to be much better on home ownership, because that $300,000 or $400,000 home grows based on the $300,000 or $400,000 it's worth, not based on the $20,000 that you put into it in buying the home. So income is black and white. So now let's talk about these 3 categories across the top. Conventional is essentially talking about Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac are 2 government departments that set the rules. They write the recipe for me on what it takes to qualify you. And no matter if I use Fannie Mae or Freddie Mac, they are considered a conventional loan. So we kind of talk about Fannie and Freddie, or at least I talk about them as the Coke and Pepsi of the mortgage world. So you go to a restaurant and you say, hey, can I have a Coke? I'm sorry, ma'am, we only have Pepsi. Whatever, I don't really care. Coke or Pepsi, it's the same thing to you. You have a preference, but it doesn't really matter because it's kind of the same thing. So to us, it doesn't matter to you whether or not you get Fannie Mae or Freddie Mac, you're getting a conventional loan. Conventional loans, I put on here 5% because that's the normal amount of down payment that's required. But if you're a first-time home buyer, meaning you haven't owned a home in the last 3 years, you can actually put as little as 3% down on a conventional loan. And the rates are super, super good. So a 3% down conventional loan, if you have excellent credit, is a great way to go. The next scenario is FHA, VA, and USDA, which is what we call government loans, because they're not just partially owned by the government, but they're actually fully backed by the government. And those are much more forgiving. They are forgiving on lower credit scores. They're forgiving if you spend a higher amount of your debt, a higher amount of your income towards your debt, and they're forgiving in a lot of cases on amount of money you need for a down payment. Speaking of down payment, I have a big red X here through the words Downpayment Assistance. 60 days ago, when COVID-19 hit and the shelter in place and the economic issues hit, the industry ground to a halt in a couple of categories. The two major categories we ground to a halt in were down payment assistance loans and jumbo loans. Well, I have super good news. I found out literally 23 hours ago that we're going to be once again allowing down payment assistance loans starting Monday of next week. So I'm going to spend a couple minutes talking about what down payment assistance means and how that applies to you in this process and how it works with down payment assistance. But in general, down payment assistance is coming back, and that is super good news. The next category is jumbo loans. Jumbo loans, not necessarily the direction we're going for first-time home buyers, but some people are on this webinar that might not be a first-time home buyer, and some people are a first-time home buyer that are looking for a really nice home as their first home. So a jumbo loan is a loan that is bigger, hence the word jumbo, than what the government will allow. It depends on what county you're in, and it depends on what type of loan that you're doing. For example, in Sacramento and the 5 Sacramento area counties, the regular limits go up to about $560,000. I'm ballparking there. So you've got, if you're anything over that dollar amount in your loan amount, either conventional or FHA will not back your loan. That's when you have to go with a jumbo loan. Now, historically, jumbo loans required anywhere from 5 to 20% down. Today, only the big banks are doing them until next week when we re-release them. That's the word, re-release. So when we re-release jumbo loans, we're expecting to require 20% down on all of them. So that is a bigger challenge. You have to have a bigger down payment. You absolutely have to have excellent credit, and your debt to income ratio is more restrictive than most of the other options. So again, guys, if you have questions, if you're on Facebook, post them on Facebook. If you're on Zoom, post them on Zoom chat, and let's go ahead and keep going. So I want to talk about the money that you need, how much you need, and where it comes from, because this is the single biggest question I get from home buyers when they're thinking about buying a home. So down payments versus closing costs. So VA, if you're a veteran of the U.S. military, thank you for your service. In response for your, in recognition of your service, VA allows you to purchase a home with 0 down payment. So really great terms, 0 down payment for a VA loan. USDA also lets you do 0 down. Now you're thinking to yourself, John, USDA, isn't that the United States Department of Agriculture? And the answer is yes. John, why does the U.S. Department of Agriculture have anything to do with mortgages? Well, that's a great question. Let me tell you. It's designed for rural communities. So it's designed for areas that are underserved, that are lower populations, and it really came out because the Department of Agriculture had major issues with farmers in Middle America being able to have workers on their farms, be able to live nearby and provide stable housing for those workers. And so USDA came out and said, fine, we'll solve the problem. We will back those mortgages so that the banks will do a loan and give them lower down payments and better terms. We're not in Middle America, but if you go outside of the major metropolitan areas, a little bit up the hill, a little bit outside of town, you're able to do loans using USDA. My favorite little sweet spot geographically for USDA loans is Galt, because Galt is grandfathered in. The maps we used for the census to determine USDA were based on the 2000 census, and Galt was a really small town in 2000. The 2010 census happened, and in 2011-12, when they rolled out the new numbers, Galt was no longer considered rural. But we were in the middle of a major housing problem, and the federal government said, we wave our magic wand, we're going to ignore the census rules from 2010, and we're going to use the census numbers from 2000. Well, guess what? A month or two ago, and currently we're in the middle of another census. Those numbers, the population figures, will be released within the next year or so. The big question is, are they going to then change the areas that we can do USDA loans, or are they going to continue to grandfather back to the 2000 census population numbers? I have no clue. We'll find out when it comes out. A conventional loan, you can put as little as 3% down. And again, that's only if you're a first-time home buyer, otherwise it's 5% down. And an FHA loan, you're putting 3.5% as your required down payment. Now, where does that money come from? 3 places: your money, gift money, or down payment assistance programs. Now, your money can come from savings. It can come from your 401k. When you pull money from a 401k, you can take it as a loan and you pay yourself back, and I don't have to count that loan payment against your income to debt ratio. Or you can take it as a withdrawal. If you take it as a withdrawal, you're paying penalties and you're paying interest. Now, currently, because of COVID-19, the federal government has said, hey, we're going to waive the penalty, and you get to, you don't pay interest, you pay income taxes. That's what you're paying. So the federal government said, we're going to waive the penalty because of COVID-19, and you have 3 years to pay back the taxes on that money instead of having to pay it back in the following year. So that saves you a little bit if you do take a withdrawal from your 401k, but just be aware that if we can do anything to stop from pulling from your 401k, we're better off, because otherwise you're cannibalizing your future savings. All right, gift funds. Gifts are a great way to get a down payment. I jokingly say the #1 down payment assistance program is the down payment program of Bank of Mom and Dad. So if you can get mom and dad to give you a gift for your down payment, there's no interest charged. Half the time you never have to pay it back. Great bank. Don't know how they stay in business, but they do. So that's a good option for helping you with down payment. The last option for down payment is down payment assistance programs. Down payment assistance programs come in 2 forms. You've got grants and you've got loan. And you say, well, John, if I have a choice of grant money or loan money, I'll take grant money, please, because I don't have to pay it back. Well, that's true, but there's always a catch. And the catch is that if you're getting your down payment assistance money via a grant, you're paying a significantly higher interest rate on the mortgage, and that higher interest on the mortgage is really going to pay for the grant money that you got. If you get a loan for your down payment assistance, you have to pay that money back later. You don't have to make any monthly payments on it, but you have to pay it back when you sell the house, when you refinance the house, or in 30 years when you finish paying off the mortgage. So just remember, there is no free lunch. Any of the grant money is not free money. So just be aware that you have to pay the money back in one way or another. What I'll tell you is all of the programs have a little bit higher interest rate and higher fees than if you put your own down payment money. So if there's an option for you to get your own money or gift money, the program, the loan, your monthly payment, and the fees are going to be cheaper than if you got the money from a down payment assistance program. All right, so now let's talk about closing costs. And you say, okay, John, don't I split that 50-50 with the seller? I think my agent told me that. Well, that's kind of true, but kind of not. There's 2 fees that you split 50-50 with the seller as a traditional, customary way that the contract is written. That doesn't mean it's going to be written that way every time, but we already are accounting for those 2 fees being paid by half by you and half by the seller. We're not taking this average of $10,000 of closing costs and splitting it in half. Those fees, my company charges $1,525. You're going to pay $500 for an appraisal. You're going to pay maybe a couple $1,000s for title company's fees. The title company's role is to act as the neutral third party. So if you think about it, when you were a kid and you had a baseball card that you wanted to trade with a friend for their baseball card, you're always worried about, well, if I give you my baseball card first, is he just going to run away and not give me his? And so maybe you went and got somebody's mom, or you went and got the teacher and said, look, I'll give it to the teacher and you give it to the teacher, and then she'll give it to both of us because she has no interest in this trade. So she'll take both of our cards and she'll hand the other card to the other person. That's exactly what the title company does. That's actually called the escrow process. The escrow officer is making sure that you are getting a home that has no other debt owed on it, that the seller that's selling the home has the legal right to sell it to you, and that you will be the sole owner once you pay for it. The seller, the escrow company is also confirming that the seller is going to get all of their money, that they're going to get the money from me as a lender, they're going to get the money from you. They're making sure all of the contractual details are, everybody is happy with the requirements. And if one party says, I'm not ready to close because they didn't do what I expected them to do, then the escrow company says, fine, I'm halting everything until you guys work it out. So they're that neutral third party. The title insurance you pay for protects you in case the escrow company missed something. So what if there was another loan that was owed on that property that didn't get recorded or released properly, and now down the road you're trying to sell the house and you can't because that loan is still there, or it was popped up, or somebody says, hey, I was owed that money because I used to own that house and I never signed off that I sold it. That's where title insurance protects you, but you have to buy a title insurance policy that protects you and one that protects me. Then you have to pay for what we call prepaid expenses. That is interest, insurance, and taxes. So you're putting money into the account to pay for future interest, future insurance, and future property taxes. We put all of that together, and that is an average of $10,000. So if you're running numbers and you want to say, hey, about how much is my monthly payment going to be, the best calculator out there is my calculator. And my calculator can be found by going to app.johnloanking.com on your phone. So if you go to app.johnloanking.com on your mobile phone, it'll take you to your app store to download my mobile app. The calculator on there is amazing. It'll give you all of the numbers. The rate is projected super high. Right now, I think we have the rate at 4.125. Talk to me about your circumstances to determine what kind of rate you would get. But on average, rates are around 3 to 3.5%. So my calculator averages the rate super high on purpose because it's not designed to be a rate quote. It's designed to give you a rough idea of monthly payment, but you can change the rate right on there. Just click on rate and change it to whatever number you want. The calculator does not include closing costs. So when you're looking at the payment on the calculator, again, you can get my calculator by going to app.johnloanking.com on your mobile phone or mobile device, and you can download it. It'll tell you how much you need in down payment. Add $10,000 to that number for how much you need in total, including the closing costs. But here's where your closing costs come from. They can come from the same 3 sources as your down payment, but they can also come from a seller credit or a lender credit. Now, why would I as a lender pay for some of your closing costs? Because I'm a super nice guy. No, I am a super nice guy, but that's not why I'd pay for your closing costs. We would pay for your closing costs because we're increasing your interest rates. By you agreeing to pay us more interest over the life of the loan, we will agree to pay up front for some of those fees. It's a trade-off. And the bad news is in today's market, that trade-off is not in your favor. And there's a lot of reasons why, and I don't have the time to explain it right now, but I'll tell you that in normal times, we can bump the interest rate a little bit and get you a pretty sizable credit. In today's world, that's just not possible. So the next best way to get a help with your closing costs is a seller credit. Just be aware that makes you less attractive to the seller for 2 reasons. First of all, financially, they're getting less money. You say, hey, I'm gonna buy your house for 350 grand, but I need you to give me 10 grand towards closing costs. Well then, buddy, you're giving me only 340 for my house, and I got somebody else offering me 345. They're gonna take the guy offering 345. But as a matter of fact, they might say, well, that's only giving me 340, and I got somebody else offering me 335. And you think, well, then they're gonna take my offer because my offer gives them 340. Not always, because the second reason it makes you less attractive is you're telling the seller you have no fallback plan. What if something happened and your car broke down and you had to buy a new car or pay a significant repair to fix your car? In the eyes of the seller, you don't have enough money to pay your own closing costs, which means you likely don't have enough money to pay for a repair, and that might mean you can't pay your down payment. And so maybe they're willing to trade a little bit less in sales price in order to get a more sure thing transaction. Now that other buyer may not be any more sure thing than you, they might be even worse off. But there's only certain things a seller can ask about the buyer, and they assume other things. When you're asking for a seller credit, you're giving more ammunition to the seller, assuming that you are less likely to succeed in purchasing a home. So that's really, we do it all the time. We get closing cost credits from sellers all the time. So don't misunderstand me. It's a great tool when you have a great agent who's a good negotiator. That's the #1 thing, as I told you earlier, is to have a great agent that's a great negotiator. But seller credits are a great way to make it happen. Just realize that you're dealing with the challenges that makes you a little less attractive to the seller. All right, I got 5 minutes left. A couple things I want to cover still. I want to talk about interest rates. So interest rates are kind of like gas prices. There's the price of a barrel of oil, which determines overall what the average price is. But there's a lot of other factors that come into the gas prices. It might have to do with whether you've got a car that needs a Supreme or a diesel. It might have to do with where you're buying and what region you're in, or if it's Chevron with Techron, you got to pay an extra 10 cents for the Techron, right? So There's a lot of factors that go into it. Here's 30 different examples of factors that go into an interest rate quote. The most important thing I want you to take away from this is there is no such thing as today's rates. I have a lot of people who ask me, John, what's the mortgage rate right now? I don't know. But if you have some time, I can ask you some questions and I can tell you what your rate is going to be. But your rate is not going to be the same as your friend's rates. Don't compare rates and say, I got a worse deal. There are too many factors that go into it. In general, rates are super duper low. But some people are going to say, oh my gosh, I got 2.75. How dare you pay 3 1/4? And the truth is 3 1/4 is a great rate because you don't have such great credit and you had very little money for a down payment. There's a lot of components that go into this, but the biggest components are credit score and percent of the home value we're loaning. Those are the two biggest components that go into interest rate. Also, don't get stuck on just the rate because sometimes you have a higher rate but a lower payment because the other scenario has more expensive mortgage insurance. So just be careful to look at the big picture. The other thing you got to be careful with rates is the fact that interest rates is derived in part by how much you pay in fee. I can show you a super low interest rate, but I'm charging you super high fees to get it. Now, there's an online bank. It's one of the largest banks out there. I won't name names, but it rhymes with Wiccan. And they are notorious for showing super low interest rates. But when you click on the assumptions or disclosures or whatever, and it scrolls you halfway down the page, it says, but we're charging you super high fees. Those fees are called points. 1 point is 1% of your loan amount that you're paying in a fee. And Wiccan charges typically 2 to 2.5 points to get the interest rate they're showing online. So be careful, because I can charge you more in fees too to get a lower interest rate, but it's not an apples to apples comparison when you go on a website like that and you're simply looking at the rate, but ignoring the details behind the interest rate. So I want to finish out in the last 2 minutes. First of all, if you have questions, please post them now so I can make sure to address them. But I want to finish out on a couple of issues that you should be concerned about. The first thing I'll tell you is job history. That's a pretty big concern, especially right now as we're coming out of the shelter in place. So if you've got gaps in employment, if you've been furloughed, depending upon the type of employment you had and how you're paid, that may not matter at all. It may be a really big deal. So if you have one of those issues, you need to talk to me about it as early as possible. The second thing that a lot of people ask you about is, do I have to pay mortgage insurance? And is 20% down the only way to get out of it? So if you're doing an FHA loan, you pay mortgage insurance no matter what. I don't care how big your down payment is, because you're using FHA because you don't qualify for a conventional loan. But when you do a conventional loan, you always have mortgage insurance unless you put 20% down. So 20% down is the only way out of mortgage insurance. But there's a little trick, and you got to be careful, because some banks will tell you, oh, we can do 10% down with no mortgage insurance. Well, it means they're not charging you a monthly fee for the mortgage insurance, but they're charging it to you either as a one-time upfront fee, or they're bumping your interest rate higher to make up for it. Either way, you're paying for it. Don't be fooled when somebody tells you, oh, I can do that and there's no mortgage insurance on there. There is. Now, sometimes that's a good idea, but it's a good idea if you understand what you're getting. It's a bad idea if somebody is tricking you into thinking you're not paying for something that you're really paying for. The second to last thing I want to cover is, will a cosigner help me? Cosigners only help with income issues. Remember, I told you earlier, income is a black or white issue. Either you have enough income or you don't. And so when it comes to income, if you have a cosigner, that cosigner will help you to pay your monthly payment, or at least we think they will, if you can't afford to make a payment on a particular month. But if you have bad credit, the cosigner is not going to help. Because the truth is, we're worried you're not even going to tell the cosigner that you can't make your payment, and you're just going to miss the payment anyway. And now, not only does your credit fall, but so does your cosigner's credit. In other words, we use the worst credit score of everybody on the loan. So if your issue is credit, which is kind of the last component here of how important is my credit, if your credit issue is your credit, a cosigner will not solve that problem, because we're still going to use your credit score in determining your qualifications. So credit is super important. I told you it's a sliding scale, and you need to make sure that you're working on your credit. So I've got a webinar in 2 weeks. It's the same night, Thursday night at 5:30 to 6:30. Go to rsvpwithjohn.com in order to register for that webinar. We'll be talking about how to work on your credits. And if you have any questions about anything at all, I know that we covered a lot in this hour. It's good overall information, but all of it is general advice. What you need is a conversation and a sit down with me to give you specific advice on how to get you qualified and how to take advantage of all of the amazing interest rates that are out there. So I really appreciate everybody joining me today, both those that join me in Zoom and those that join me in Facebook. Thank you so much. Give us a call. You can email me at john@johnloanking.com. Download my mobile app by going to app.johnloanking.com. And if you want to see all of my videos, go to my Yelp page, and that is go to Yelp and then search John Loan King, all one word, John Loan King, or you can go to yelp.com/John Loan King. Thanks, everybody. Have an absolutely amazing day, and call me if you have any questions. I look forward to helping you out. Bye-bye.